Hey traders, welcome back. We've got a brand new trading strategy that we are implementing in our live trading room that we've had a lot of success with. It's still new, but very, very exciting. I wanted to share that with you guys today. All right, let's go ahead and jump into this. I'm really excited about this. We have added probably 4 new, unique trading strategies to our live trading room over the last month or so. When I say new, I mean new. I mean, these are strategies that most of you, even if you're a seasoned trader, it may not be a brand new concept to you, but it's probably not something that you are doing or have done. And in that sense, it is a new strategy. Those are always fun to come up with new ideas. So this is what we call a positive Vega credit spread. If you're familiar with the option Greeks, you realize that most credit spreads are negative Vega, not positive Vega type trades. And so Vega, or the expansion thereof, ends up hurting our trade. So this is a way to apply credit spreads with an edge for that protection against a volatility or a Vega expansion. So let's take a look at it here, and I'll give you kind of an idea or an overview of what the trade looks like, sort of the rules and the nuts and bolts of the trade. We'll jump in, we'll take a look at a real life example of one. I'll come back again, reestablish with you all of the nuts and bolts and all of these aspects of the trade. So if it's something that is interesting to you, you can go out and start looking at building some of your own with these. So it is a laddered trade. It is a laddered approach, meaning that we are going to put multiple separate, distinct tranches of this trade together over time. So it does work as a multi-tranche trade. It is a ladder trade. Generally speaking, maturity date wise, these are going to be 30 to 60 day trades. 30 to 60 day trades is the time frame that we are looking at. And so we're going to put a new version of this trade, a new tranche of the trade on every 2 weeks. Okay, every 2 weeks we'll put on a new tranche. They are usually 30 to 60 days in maturity length. And so that means that on average, as you do roll these out every couple of weeks, every 2 weeks we add a new one, you're going to have, depending on the maturity lengths, anywhere between 3 and 6 of these trades, all working simultaneously. When one rolls off, you're going to add another one, et cetera, et cetera. So again, depending on maturity lengths, you should have anywhere between 3 to 6 of these trades, separate tranches of this trade, all working simultaneously. The ticker symbol that we're going to use, we've bounced around with a couple different ticker symbols, but we did land on the DIA. That's the Dow Jones Industrial Average, and it seems to work for us. It also is the only trade that we happen to be doing in our trading room that we use that ticker symbol for. So from an accounting standpoint, it's going to be really easy for us to track our results here. We probably won't look at our results day in and day out here. At the end of each month, we'll just go back through our summary accounting sheet and see where we are at on that particular ticker symbol. So we are going to use the DIA. This could work on other indexes, but we're going to use the Dow Jones. So the DIA is the ticker symbol that we're going to use. Again, we're looking at maturity dates somewhere between 3 and 8 weeks. It's generally going to be, 30 days to 60 days is the sort of the sweet spot for this trade. We're going to be looking at using 10-point wide spreads on the trade, setting this trade up with a 10-point wide spread, and have a goal of netting, after everything is said and done here with this trade, we want to net $1 credit per spread. So a 10-point wide spread would be a $1,000 capital commitment. A $1 credit would be a $100 credit. That's minus out of your capital commitment. So really you would have $900 committed to the trade, or buying power committed to the trade, with a $100 income potential per spread. And so that would be, again, a $1,000 commitment on the per tranche and a 10% return potential if we can get that $1 net credit. Okay. Single spread versus iron condor. Now, this varies. I will say that it's probably 50-50 on this trade setup in terms of whether we just get a put spread in, a call spread in, or both of them. And of course, with both of them, we would form an iron condor. It does depend on the market bias, depends on if we're in more of a consolidating mode or more of a trending mode. And it does depend on support resistance levels and option pricing skew and where the meat in the options market is. Is it on the put side? Is it on the call side? So there's varying factors that would go into this. Sometimes we will have a full iron condor on. Obviously, that increases the return potential, but it also increases the risk as well. So sometimes we'll have single spreads. Sometimes we'll have a full iron condor. I will say that the two that we have working right now are both single spreads. We did not, because the market has been trending to the downside, we only had one side in on those trades. But that will vary, just depending, again, on those market situations. Our stop loss exit for this trade is 3 times the credit received. So if we were to get to one of these positions where our $100 credit turned into a $300 loss, we would exit the position. We will use stop losses on this trade. There's not any adjusting in this trade. That's the purpose of laddering. The laddering part of this trade is what's going to give us a smoothing of our equity line, and it basically takes the place of adjusting. So if we do have one particular tranche that hits that 3 times credit received, we'll just exit it with a stop loss. Now, the long Vega component, okay? This is really the secret sauce, if you will, to this trade. The long Vega component, which I'm going to show you, I'm going to demonstrate here in a second, is essentially marrying a small, very, very tiny, out of the money, long call or put position, depending on whether it's a call spread or a put spread, marrying that long position with the credit spread. So we would have a tiny debit or a tiny long position married to this credit spread. And the number one thing to understand with this long Vega component, so obviously a long option, whether it's a put or a call, should increase in value if we get an expansion of Vega, expansion of volatility, right? So this is probably the most misunderstood part of the trade. It's also probably the most important part of the trade. This long Vega component, the purpose of the long option is not to invert Vega, okay? In other words, the purpose of the long option is to invert Vega. It is to make that volatility expansion not hurt our trade. So the purpose of the long option is to invert Vega, nullify Vega expansion. It's not to hedge delta, okay? It is not used as insurance. It is not used as a protective leg. We do a trade in our trading room that we call the Dragonfly, which is essentially an iron condor with protective legs inside of the short legs. That's not what this is. This is not a hedging strategy. It is not a way to protect against a delta move. It is a way to invert Vega. It is a way to take that expansion of volatility that just absolutely kills and crushes a credit spread and instead turn it into a positive effect, okay? The trade intent, basically what we're looking here with this trade is that if you take the trade and you put it into a risk graph, you could simulate a Vega spike of up to 50%. So, let's say that there's something crazy that happens with the market. I don't know what it is. It could be the Fed. It could be a war. It could be anything. But you have this shock to the system. You have this Vega spike, this volatility spike of up to 50% in the market. That would, again, normally absolutely crush the credit that you have received on a normal credit spread. In this instance, it is going to either fully eliminate those losses or, in the worst case scenario, at least mitigate them by quite a bit. Okay. Position sizing on this trade, we recommend, generally speaking, with most of our trades, that you don't put more than 10% of your overall portfolio in any one position or approach or strategy. In this particular trade, I bumped that up a little bit to no more than 15% of your overall portfolio, because we are spreading that 15% out over, say, on average 4 trades, 3 to 6 tranches going in there. And so it will be laddered and it will be spread out over different expiration maturities. Okay, so that's a quick overview of the nuts and bolts of the trade. Let's go ahead and take a look. Here we go. Nope. Here we go. Let's go ahead and take a look at an example one. Let's jump into a risk graph and I'll walk you through an example from A to Z. Okay, let's see if we can walk through an example here. We actually have one of these long Vega, long volatility trades already up and working in the DIA, and I'll use this one as an example for us. So we've actually got both sides of this trade working. We've got the calls and the puts. We just added the call side today, but it works exactly the same for the call side as it does on the put side. So for simplicity's sake, I'm just going to isolate the put side here, and you can see I've got a credit put spread here. I sold these are September 16th expirations. I've sold the 290 short put, and I bought the 280. So it's a $10 spread here. And then I bought this very, very out of the money long 135 put. Okay, so I've isolated this out by removing the call leg for simplicity's sake and removing that long put leg and just looking at the put spread. So this is our trade-in. Most of you are familiar with reading risk graphs. This line right here is where we would be in this trade at expiration. So when this trade expires, this is where we would end up at. However, this orange line is our theoretical profit and loss in the moment. And so, as you probably know with these trades, the challenge here is, let's go look for a second at the overall trade. So if we go into our positions, we go to here, let's see, let's move this. Let's go to the table. There we go. So here's our put spread, and here is that long position way down here that we purchased, I think for just a penny. But the delta, let's take a look at delta here. You can see that the delta is about a 7 delta. So this is what you would consider to be a fairly safe trade, right? This is essentially a 93% probability of success trade. It's very safe, 93% chance that it's going to end up making you money. And if you look at the numbers on the trade, the DIA trade here, you can see that we've got $1,000 in the trade. We brought in $160. Now that's a little bit misleading because we do have the call side in there as well. But I do think we brought in something around $100 on the put side of the trade. So it all looks really good, right? This is a trade that is about 49 days. It's a very high probability of success trade with a very high profit potential. It all looks great. But the problem here is these two lines. This is the result at expiration. But the orange line is where we would be P&L wise if we were in the moment, if this is where the price was right now as we speak. So if you look at the top up here, you can see as the price starts to come down, and again, remember our goal here is we're putting up about $1,000 per contract. It's a 10-point wide spread, so we're putting up $1,000. We're bringing in about $100 in income. So actually, our buying power that's required for the trade, you minus out your credit from the initial margin requirement. So our actual buying power here is about $900. And so we're looking for about a 10% return, okay? So in theory, easy, nice round number. We're looking for about $100 profit. Well, watch that theoretical profit and loss number. As the trade comes down, 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 now we're into the red, right? Now we are losing money. Now, the trade still theoretically is solidly in the green. It is solidly in the profit zone, and you may actually feel really good about the trade still sitting here, because that's still a long way for it to go. But the more that it slides down here, the bigger you see that theoretical profit and loss get. It just gets bigger and bigger until we get down maybe right in here, let's say, right there, and it's a 1-for-1 loss. We were trying to make $100 on the trade, and now we've lost $100. And yet the trade is still in the profit zone. We're still in the profit zone, but we've actually lost a 1-for-1 ratio, right? And it starts to get uglier at that point. So we want to try to do something to mitigate that. And in fact, it gets even worse. If we use our analyses tab, we can come over in here and say, you know, one of the things that accompanies big downward moves in the marketplace is usually a spike in Vega. So we could, first of all, here, we could illustrate that move down. You can see our open and theoretical profit and loss here on the trade. Let's say that the spot price does start moving down. Now, again, we're making money on this trade anywhere above 290 at expiration, right? But watch what happens up here to your theoretical profit and loss as we start dropping $1 at a time. Now, again, we're going to be in the profit zone above 290. But we start getting down here to the 310 level, 38 level, 305 level. Here's the 300 level. We're at more than a 1-to-1 loss. We're still nicely in the profit zone, but we're showing a big loss because of that directional, that delta move, right? So that could hurt us. But you know what really hurts this trade? What really hurts all credit spreads is a increase in Vega, a expansion of volatility. So you can see this trade right here. This is the September 16th puts that we're looking at. Here's the September 16th puts right here. Let's say that we get a volatility spike. Something happens in the marketplace, and not only do we start moving down, but we get volatility spiking. Now let's push volatility up by just 20%. This trade is actually built to absorb up to 50% bumps in volatility. But let's just bump it up by 20% here. Now, right there, that looks pretty awesome. A bump in volatility, we're actually making more money. Well, that's just because we've highlighted the long leg of the spread. Let's get both legs going here. Here's your short leg. That's the leg that gets hurt when volatility pushes. Let's move that up by 20%. There's 20%, and now you see it's even worse. Now you see that we're really starting to accelerate the losses here. You know, now we're down to almost a 1.5 times loss here, because again, the more that volatility spikes, the worse off that trade's going to be. And so you're in a weird situation where, you know, maybe you're sitting right down here, and you're like, you know what? I'm still solidly in the profit zone. If I can just get this trade to expiration, it's going to be fully profitable. And yet I'm sitting as it is on a massive loss. So let me reset all of these. Let's go back to 0. And now we're going to come back in and we're going to add in that long put. Okay, so you remember the long put? It's way down here. I believe we paid 1 penny for it. It's showing right now a ask of 2 cents and a bid of 0, and I think we paid 1 penny for it. Very, very far out of the money. It is not meant to protect against a delta move. It's meant to invert Vega. And what I mean by that is, let's go back to the curve now. We've got that added to our mix. And now let's start to expand Vega. Okay, let's say that Vega starts to expand here. And again, we'll come up 20 points and we'll look at the call leg. We'll add in that short leg now, up 20 points. And you can see that at the point that we're at right now, we still wouldn't basically have had any losses. Very teeny tiny losses. If our Vega, if our volatility pushes less than 15%, you can see that really it doesn't affect us at all. So that's what that leg is doing, is it's just giving us a little bit of extra protection here. Oops, I'm sorry, I didn't even include that leg in it. Let's make sure that that's included in the transaction here. Here we go. So let's bump this up by 15% and watch your theoretical profit and loss here. Okay, let's try this again. So here is the put spread, just as we looked at before. Let's spike it 15% in volatility. You can see the losses that they start to accentuate down here. This orange line starts to get lower. But now let's bump our long position that 15% as well. And you can see that that starts to help our position here. So let's do it again, and let's look at the volatility levels here first of all, so that I can show you the leverage in the trade. So let's go to the trade. There's the 49 days. You can see, let's go to implied volatility. You can see the implied volatility on the put spread here is about 23 to 26%. Let's call this 25. Okay, so this is about a 25% IV. And you can see that our IV down here is very close to 75. It's about 3 to 1 ratio. There's a lot more leverage. There's a lot more gamma effect in this very teeny tiny position. So it is essentially 3 times levered, okay, in terms of Vega, in terms of volatility. So let's come back here. Let's say that that volatility spiked 15%. And this is the effect that it's going to have on our put spread. We've looked at this a couple times now. There's 15%. So you can see it's hurting us here in the theoretical profit and loss. Now, we're going to 3 times that volatility, because that's essentially what we're going to get, is it's going to get 3 times as volatile on that very long put. So we're looking for something like 45%. Keep your eye on this orange line. You're going to keep going, keep going, keep going. Watch the orange line. And you can see that by having that basically 1 penny cost, which would be $1, having that $1 cost position, it would actually bump us into a higher profit. In other words, a event that normally would hurt us, meaning a rise in volatility, would actually sink our trade, actually helps us improve the trade. So that's a quick overview of how that long Vega position works. It is not insurance. It is not a hedge against a delta or directional type move. It is in place to help us invert Vega. Hope that helps, guys.